Good morning and welcome to Financial Accounting. As we start with our calendar, everyone should have completed the exam by yesterday, and I believe that is the case. I just looked briefly just now, and I think everyone who is ongoing in the course did take the exam. If you have any questions from the exam, though, please let me know. I'll be happy to help you with those. Generally, we need to do that outside of class time, or at least it can't be on the recording. And the project also should have been submitted yesterday. So if you have not yet turned that in, make sure you get that in as soon as possible. On Thursday, we held the drop-in review session, and we went over the Chapter 9 problem. So the video was out there for that. If you have any questions about that, let me know. I do not yet have a drop-in review session scheduled for this week, but if there is a desire to schedule one for either Thursday afternoon or maybe Friday. My Friday's pretty full, but I would be happy to do that. Just need you to let me know that you would like to attend one and what time you would like to attend, and I will get that scheduled. As you can tell from looking at our calendar, then we are on break next week. I think you all know that. I think people are probably looking forward to that, a little bit of downtime, maybe catch up time, catch up on your sleep if nothing else. But we'll be finishing Chapter 10 today. And so the Chapter 10 exercises should be submitted by the end of the day. Chapter 10 problem on Wednesday, and then the Chapter 11 pre-quiz. Chapter 11 will be covering Wednesday and then finishing up after the break. And then right away, we'll have our next exam coming up because exam 4, as you know, only covers chapters 10 and 11 on liabilities. So that'll be coming right up for us right after the break when we finish up Chapter 11. Any questions about where we're going from here? Anything you want to talk about? Alrighty. So we will go right to our exercises. And as I said before I started recording, we'll be picking up with exercise 5 today. Last class, we talked about some current liabilities. We talked most of the exercises we did related to notes payable and the accrual and calculation of interest. Any questions about anything related to notes payable that we talked about last class? And then I spent the last chunk of class talking about mostly the federal income tax structure. And as I told you last class, I spend more time than maybe is strictly necessary to understand the accounting part of it. But I do think it's really important for individuals who are or will be taxpayers to understand what all of that means and where those calculations come from. So before we get into this exercise, does anyone have a question, anything you want to talk about related to I can't even say discussion because I know I was just presenting information, but any questions about anything that I presented last time related to the calculation of federal income taxes and other taxes that affect your paycheck, such as Social Security, Medicare, anything else? Anything you want to ask about? Okay. I probably said this last class, but if you do have a specific question that's specific to your personal circumstances, I would be glad to help with that if I can, but we should do that outside of class. And you can schedule an appointment with me or just email me a question if you want to do that. But we'll go ahead with our first exercise for today so we can finish up this chapter in a timely fashion today. This is exercise 5. K Mello Company has 3 employees, a consultant, a computer programmer, and an administrator. The following payroll information is available for each employee. So you can see the consultant is paid a flat amount per week. And so that would be what we would consider a salary. Normally, when you hear the word consultant, you might think that this is an independent contractor. However, an independent contractor would not have federal income tax withheld. So we know that this individual is an employee of the company, but he or she is simply a salaried employee. The other 2 individuals, the computer programmer and the administrator, are paid by the hour. So those are wages, not salary. The consultant isn't eligible for overtime because of the salaried position. Now, just as a point of clarification, there is a federal standard that if your salary is below a certain level and it's somewhere in the range of $45,000 a year, even if you are salaried, you would still be eligible for overtime or compensation for any time worked over 40 hours. In this case, because the salary per week does exceed that threshold, the consultant is not eligible for overtime, and but the computer programmer and the administrator are subject to overtime or qualified for overtime. For hourly employees, overtime is paid for hours worked in excess of 40 hours a week. I would suggest that this 2 times the hourly rate for the computer programmer is an individual decision. There's nothing statutory about that. That was an agreement apparently reached between the computer programmer and K Mello Company. For the current pay period, the programmer worked 48 hours, the administrator worked 51 hours. Assume that Social Security is 6% and Medicare is 1.5%. And we talked about those rates in class last time, and we know the actual rates are 6.2 and 1.45. But as is sometimes the case for the software, they've asked us to use rounded values for those. So those are not the exact correct values, those are rounded numbers. So the first thing we're asked to do is calculate the gross pay and then the net pay. So gross is the total amount that you've earned, and then the net would be after any withholdings. And for these employees, our withholdings are going to include just 3 things: federal income tax, Social Security, and Medicare. We did talk about last class some other types of withholding you might see, including union dues, any contributions toward benefits such as health insurance, vision, dental coverage, life insurance, anything like that. You might have withholding for state income tax if you live in one of the 43 states that does have state income tax, live or work, I should say. You might have withholding for charitable donations such as United Way or the JCC Foundation. For this purpose, though, the only thing we're considering is federal income tax, Social Security, and Medicare. So we'll start with the consultant. The consultant's the easy one because he or she is paid a salary. The gross pay is always going to be $5,000 per week. But from that, we need to, I'm going to see if I can just slide this up a little bit. From that, we are going to subtract, I'll just list these down here. We're going to be subtracting the federal income tax, also Social Security and Medicare. So we'll be calculating those amounts for each one of the 3 positions and subtracting those from the gross to get to the net pay. So again, our consultant is going to be the easy one. The federal income tax, we did talk about, I showed you kind of briefly last class, how that federal income tax withholding is calculated. You first do an estimate of what your annual pay would be based on your pay for that pay period. And you use those federal income tax withholding tables that I showed you to estimate how much your total tax would be for the year if that was the amount that you made every pay period. You have withholding taken out to meet that obligation. So in weeks that you have a bunch of overtime that maybe you don't have on a typical pay period, your withholding as a percentage would be, excuse me, would be a little higher, because again, the assumption is you're going to make, the tables are based on, you're going to make that same amount every pay period for the entire year. And so in weeks that you make more, as a percentage, your taxes are going to go up. And in weeks that you make less, it would be a lower percentage in total. For Social Security, we're going to be using those rounded off numbers. So $5,000 being our gross, if 6% of that would be $300. So the consultant would have $300 withheld from that paycheck for the Social Security obligation, and the Medicare at 1.5% would be just $75. I know we talked about this last class, but just a reminder, this consultant is paying $375 toward FICA, Social Security, and Medicare. The employer would also be matching that and paying an additional $375 into the Social Security and Medicare system. So now we can calculate our net pay. And so that's just the gross pay minus those 3 withholdings. Now for the computer programmer, any questions about the consultant piece? Okay, so for the computer programmer, we need to do a little bit more calculating, because the computer programmer earns $50 an hour for the first 40 hours that he or she works, and then earns $50 times 2, because he gets paid 2 times his hourly rate for the remaining hours. So the computer programmer worked a total of 48 hours. The first 40 are paid at straight time, and the rest of them, the next 8 hours, are paid at double time. So if I did the math correctly, the computer programmer would have earned $2,800 for the week. Did everyone else get that same amount? Okay, thank you. And so the gross pay for the computer programmer would be $2,800. We're then going to do the same calculations for the withholdings. We're told it's $428 in federal income tax. We know basically how that's calculated. For Social Security then, $2,800 as the gross pay times 6% would be $168. And 2,800 times 1.5% is $42. And so subtracting those 3 withholding amounts from the gross pay, I find a net pay of $2,162. Any questions about that? All right, we'll try the administrator on your own, and I will put mine on the screen. It does say if required, round your answers to 2 decimal places. So this is the first one that I see with a decimal place. Make sure you use that. Don't round your taxes. Why did I what? I'm sorry. This is his overtime, through overtime. So it's $60 an hour times 1.5 times his hourly rate. So he gets paid time and a half for the overtime. He had worked 51 hours. So there were 11 hours of overtime at time and a half. Is that what you were asking? Okay. Okay. Anyone need another moment for that? Okay, so I assume people have already looked at what I was doing on the screen since I didn't pause the recording, but let me just go through it. So the administrator gets paid $60 an hour straight time for the first 40 hours, and then time and a half for the next 11 hours because that position worked a total of 51 hours. So the gross pay would be $33.90. From that, we subtract the federal income tax, which has already been calculated for us, withholding of $572, based on those tables, which are based on the number of, the frequency of the pay period and the number of what we used to call exemptions. Doesn't work the same way now. And then Social Security at 6% of the gross and Medicare at 1.5%. Those rounded figures we were asked to use for this exercise. So, any questions about calculating payroll? All right, let me clear my drawings then and we'll go on to the next exercise. And so in this exercise, we get to not just calculating payroll, which is obviously a huge part of the accounting job for any company. Payroll for many, maybe even most companies, is the biggest single expense that the company has. And so when you think about all of the intricacies that we talked about last class, including knowing the tax information from the W-4, which is that form that you fill out to say how much withholding you want, do you need extra withholding, what are your special circumstances. So you need to know that for every single employee. You need to have those federal withholding tables in mind, frequency of payroll. For the majority of companies then, they're also withholding state income tax for the state where they are located, plus Social Security and Medicare, and keeping track of that Social Security wage cap that we talked about last class, plus all of those unique withholdings that employees might have, again, that we reviewed at the beginning of class, including union dues and benefits, amounts that are contributed, and maybe vacation pay, maybe disability pay for workers who are out on disability, and all of those other pieces that go into that calculation. Payroll is really very challenging, especially for companies with large amounts of employees. And it's also, if you think about it from your own perspective, really important that you get it right. Think about how you'd react if your paycheck wasn't calculated correctly. If you didn't get paid in a timely fashion the correct amount, if you got to the end of the year and did your income taxes and determined that they hadn't been withholding the correct amount from your paycheck. Now, all of those things are very critical issues for employees. And so that's one reason that payroll for many companies is outsourced to a specialist. So because it is so tricky to stay on top of all of the changes that happen at least every year. And so it is frequently outsourced to companies like ADP or Paychex to handle that payroll for you, because those companies, that is what they specialize in. And so you can be more assured that the payroll calculations are going to be done completely correctly in a timely fashion, and you know how much needs to be paid into those taxing authorities, federal, state, local income tax, the Social Security and Medicare parts, and that your employees are going to remain happy that their checks are calculated and paid correctly. So all of that is kind of the background stuff for the actual recording of the accounting entries, because we have not done that yet. And that's what we're going to look at in this exercise. And then in exercise 7, we'll talk about another payroll related consideration when it comes to current liabilities. So according to a summary of the payroll of Mountain Streaming Company, $110,000 was subject to the 6% Social Security tax and the 1.5% Medicare tax. Also, $25,000 was subject to state and federal unemployment taxes. So we've talked about this from the employee side, and I pointed out to you in just last class and just reminded you in the last exercise that what is withheld from your paycheck for Social Security and Medicare is matched by the employer, and you really don't even see that. And from my experience, I would suggest that most people are not even aware that that is happening in the background because it's not visible to you. So that last exercise, the consultant had $375 withheld for Social Security and Medicare. And I said the employer pays in another $375 for a total of $750 being paid in, but you as the employee see only the part that comes out of your check. The other part, and I mentioned this, I mentioned last class, I said I had another story I was going to tell you about another former student, and it is related to this concept of unemployment taxes. So many years ago now, probably not as long ago as the story I told you last time about the student who was not aware that you paid income tax based on how much you earned, and companies do as well. I had another student many years ago, and she worked a job that, I'll tell you the story in the order that I learned it. So she was in my office, and she was upset, and she was, just kind of talking to me about some issues she was having. And one of the things she mentioned was that she had been laid off from her job, but that she couldn't collect unemployment. And so because she brought it up to me in a private setting, I said, so what do you mean you couldn't collect unemployment? If you were laid off because of slow business at your company, you should have been eligible for unemployment. Tell me more about this. And it turns out, it came out through the conversation with her, that she had been working the job illegally. That is what we euphemistically call under the table. And so it wasn't a legally reported job, and she'd been working there for a number of years. And when the company had a setback, they eliminated her position, laid her off. But because it wasn't a legal job in the first place, she wasn't then eligible for the benefits that a legal job would have included. And so since then, I have made more of a point to talk more about this piece of it, which is the unemployment taxes. So especially with COVID, I think everyone is very aware of what unemployment is, and that there is a state part to it. And then in dire economic times like we we're facing during COVID, the federal government will then kick in to extend that unemployment. But so unemployment benefits start at the state level, but can be continued at the federal level. So what this student did not realize is because she wasn't being paid as a legal employee, because she was being paid under the table, her employer was saving money. Not only was she not paying income tax on her earnings, which is obviously not legal, the employer was also not paying into the system on her behalf. They were not paying Social Security, Medicare for her. So all of her earnings, I think she'd worked there like 3 years, if I recall correctly. And so for those 3 years, her earnings were off the books or under the table. And so not only was she not contributing to Social Security and Medicare, her employer was also not contributing to Social Security and Medicare. And what was also not clear to her was that the employer, because they weren't reporting her as an employee, were also not paying into the unemployment system for her. And that's why she was not eligible for unemployment, because it had never been paid. Unemployment is funded by the employers. And so companies that have a high rate of turnover, that end up having a lot of unemployment claims against them, pay more into the system than a company that never has unemployment claims against it. And so what the student, Christy, did not realize was that she wasn't eligible for unemployment because the unemployment had not been paid for her. So unemployment is paid by the employer. It is not visible. It doesn't show up on our paychecks that it's being paid on your behalf. And so I think most people probably don't even think about it, aren't even aware of where does the money come from to pay those unemployment claims, but it comes from the employer indirectly. So the first X amount of dollars that are earned at the beginning of the year are subject to unemployment. As I said, unemployment can shift. So the numbers that are given in this exercise or in the book are based on usual or typical situations. But the employer, in this case, Mountain Streaming Company, pays into the state. And for this exercise, we're going to be using 5.4%. It's not the entire payroll. So their entire payroll, we're told here, was $110,000, but only a portion of that is subject to unemployment. And so the $25,000 is going to be used to calculate how much are we paying into the state for unemployment. And then you'll notice the percentage for the federal is lower because that's kind of the backup to the state. So most unemployment in normal circumstances, the unemployment is only coming from the state. And so that's what we're asked to calculate first. How much does the employer owe in payroll taxes? State unemployment, federal unemployment. They also owe that Social Security and Medicare. It's going to be easier for us to do Part B and then total those to get to the answer for Part A. So we'll do it in that order. So we're going to list these as payables. So we've got our Social Security tax payable, Medicare tax payable, state unemployment tax payable. Sometimes you'll see that, frequently you'll see that abbreviated as SUTA, S-U-T-A, and then FUTA for the federal. So, and we're going to lump those all together and call it payroll tax expense. So the debit is going to be to the expense that shows up on the income statement. And then the credits, 4 of them, are going to be balance sheet accounts to show the liability. So thinking back to that last exercise where we had the gross pay and the net pay, these payables would be the difference between the amount that the employees had earned and how much is actually in the checks. This entry, just to be clear, I don't think I was clear what I was saying. This entry is for the employer side only. So these are the taxes that are paid in by the employer. But on the employee side, we would have a similar entry that shows the total amount that we would be paying to our employees and how much the payable Social Security, Medicare, health insurance, any of those other withholdings make up the difference between the amount they've earned and the amount we pay them. So let's go ahead with our calculations here. Just going to do the calculations over here on the side. So Social Security is due on all earnings up to the Social Security wage cap. The fact that they're telling us that the same amount is subject to Social Security and Medicare tells us that no employees yet have hit that wage cap. It is possible, though, that the amount subject to Social Security would be lower than the Medicare, especially as you get later into the calendar year. But for this exercise, we are told that the same amount is subject to Social Security as Medicare. So that tells us that no one has yet hit that wage cap. And then for unemployment, it's not all of the wages, it's a much smaller amount. Now, at the beginning of the year, most of the wages are going to be subject to unemployment. And again, as you get farther into the year, there's going to be a lower amount subject to unemployment because it's based on that calendar year. And so new employees would still be, still have all of their wages subject to unemployment, but employees who had been around since the beginning of the year would hit that cap, and the employer would stop owing for that year, and it would start again in January. And so there's, whoops, yeah, that's what I know. So those are going to be the calculations that we do to calculate all of the payroll taxes. So go ahead and do those calculations. So also going into that Social Security tax payable would be the $6,600 that was withheld from the employees' paychecks. And so if the company were paying the Social Security tax due just for this month, let's say, it would be this $6,600 plus another $6,600, a total of $13,200 being paid into Social Security. Half was withheld from the employees' paychecks and the other half is matched by the company. And so on top of the wages and salaries earned by the employees, the $110,000 in this case, the company is paying an additional $9,800 in additional taxes. This is considered part of the fringe cost. If you've heard of the concept fringe benefits, this is considered part of the fringe cost of employing workers. In addition to the statutory requirements of Social Security, Medicare, and unemployment, you've got those maybe non-statutory benefits, including health insurance and vacation pay or retirement pay or anything else like that that the employers offer to their employees. Those fringe benefits easily can add up to 30, 40, even 50% on top of the cost of the actual wages and salary paid to the employees. When you add in all of these taxes, which are required, and then all of those that are voluntarily provided, such as health insurance and vacation and retirement and all the rest of those kinds of costs. And we need to, so we now can answer letter A much more simply. The employer's payroll taxes are $9,800 for this payroll. Anyone with questions about that? Oh, whoops, I picked the wrong one. I said payable, but I chose the one that said expense. Hopefully you all noticed that and had your own saying payable. I said they were all payables. Clearly we would not be crediting an expense account. Any questions about this exercise before we move on? Or anything that I'm talking about? I know I'm throwing in a lot of extra information. I just think, as I said, I think it's important for people to recognize that. And my experience tells me people don't know those things. Everybody's good? All right, let's move on to our next exercise then. So I just mentioned that one of the possible fringe benefits that a company may provide to their employees is vacation pay. And I mentioned a couple others, including retirement pay. And we'll talk a little bit more about retirement pay in our next chapter, because this chapter is focused on current liabilities, things that are going to be due within 1 year. But retirement pay for most employees is not due within 1 year, unless you are within 1 year of retirement, and then probably only a portion of it. So in chapter 11, that will start on Wednesday, we'll revisit the question of retirement pay or other post-retirement benefits. The reason vacation pay is included here, though, is for many companies, vacation is offered for 1 year. They don't allow you to roll it over or accrue that vacation and carry it over into a future year. And so for most companies, that vacation pay is a current expense and a current liability. But I want to talk about this for just a moment and have you think about what it means to get paid for vacation and what does this have to do with accounting? Because in particular, if you are a salaried employee, your paycheck doesn't change whether you're on vacation or you're not on vacation. You get paid the same amount every week, regardless of whether you're working 50, 60, 80 hours or you're on vacation. But I want you to think about this in the context of the matching principle. And we talked about the matching principle first back in chapter 3. And at the time I told you, you're going to hear me say this over and over again. The matching principle is the reason we do most of what we do in accounting, in financial accounting, that we are trying to make sure that we have a good match on our income statement of the revenues earned in that period and the expenses that helped us to generate those revenues. And we talked about how do you know that a revenue's been earned, and then we talked about which expenses go with these revenues. So let's think about that in the context of vacation. Are your employees helping you earn revenues when they're on vacation, do you think, in general? Generally speaking, your employees are helping you make money when they're working, not when they're on vacation. And so the matching principle says, well, if they're helping you earn those revenues, while they're working, not while they're on vacation, you need to record the cost of that vacation while they're actually working. And so we have to estimate and accrue or record the vacation pay before the employees are actually getting paid for being on vacation. Looking at the exercise, a business provides its employees with varying amounts of vacation per year, depending on the length of employment. The estimated amount of the current year's vacation pay is $42,000. They've done the hard part for us. They've already given us the dollar amount that they want to set aside, accrue, record as expense while the employees are actually working, to have it set aside, have that value set aside on the balance sheet so that when the employees actually take vacation, they can record it against that allowance. Very similar in concept to what we talked about with using an allowance method for recording uncollectible accounts. We set aside that allowance, and when we write off an account, we write it off to that allowance instead of recording bad debt expense down the road. Same concept applies here for our vacation. For the allowance for uncollectible accounts, just to make sure I'm not misleading you, the allowance was a contra asset. It went with the receivables in the asset section, but it had a credit balance. What we're talking about here is a liability. It has a credit balance just like that allowance, but it is a liability. It goes in the liability section of the balance sheet. And I'm actually going to skip down here to letter B. How is the vacation pay reported on the company's balance sheet? It would be a current liability unless employees are allowed to accumulate their vacation pay for use in future years, in which case part or all of it could be a long-term liability. So that's, as I said, that's why we covered in this chapter, because we need to make sure, because if it's being paid out in the current year, it's a current liability, and that's how it fits into this chapter. Retirement pay is almost exclusively a long-term liability, except the parts that are going to be paid out in the current year, which is not most of it, we hope. So the estimate for the current year is $4,200. And so what the company has decided it's going to do is take that annual amount and record it bit by bit throughout the year, so that we, again, have that good match on our, excuse me, on our income statement of the actual cost of employing the people who are working for us at the time. So $42,000 a year divided by 12 months would be $3,500 per month. $3,500 per month. Letter A says journalize the adjusting entry required on January 31st, the end of the first month of the current year, to record the accrued vacation pay. If an amount box does not require an entry, leave it blank. So again, they've decided they're going to take this estimate of the cost and allocate it in, or accrue it in what I would call a straight line fashion: vacation pay expense and vacation pay payable. Again, we learned about adjusting entries in chapter 3. We know that an adjusting entry needs to include one income statement, one balance sheet account. The company has decided they're going to allocate this in a straight line fashion, 1 month at a time. Each month, at the end of the month, they're going to do an entry that looks just like we see here. Record vacation pay expense. It's going to hit the income statement in that month, and vacation pay payable. They're going to set that aside on the balance sheet as a liability. And throughout the entire year then, they will have put into this liability account $42,000. When is this amount removed from the company's balance sheet? And the answer is when employees take vacations. And so let me show you what that might look like, because it's not included in this exercise. So each month we're recording the vacation pay expense, and we are setting aside in this vacation pay payable account a total of $3,500. So each month, $3,500, and it keeps accumulating in there. Now, I don't think a lot of people are taking vacation in January. Not a lot, maybe some, a day here or there. Your child is off for Martin Luther King Day. Maybe you take the day off from work if you work a Monday through Friday kind of job. But generally speaking, not a ton of vacation in January. Maybe in February, people decide we live in Western New York. Maybe they decide they're going to go south for a week out of the snow. Maybe in March or April with those spring breaks. Probably not so much vacation in May. Picking up a little bit at the end of June, July, August are the hot months, of course, for vacation, the popular months for vacation, because school-age children are off from school and so on. And so by entering this journal entry that we created here in Part A in a straight line fashion, we're recording the same expense every month. But some months we're paying more vacation, and in other months we might be paying very little vacation. When we actually pay the vacation, this is what the entry would look like. When we actually pay the vacation, we would debit the vacation pay payable, however much we paid, dollar signs there, and the credit would be to cash or wages payable, because we're actually paying that vacation. And so each time an employee takes vacation, we're going to remove some of that liability. So each month it goes up by $3,500, but it's going to go down by however much we pay out. The expectation is, because we estimated that in total we would pay out $42,000 in vacation, ideally, at the end of the year, it comes out about even, right? We've been putting in over the course of the year a total of $42,000. We should be taking out about that same amount if we've done a good job at estimating. And so at the end of the year, if we don't allow employees to carry vacation over, at the end of the year, what happens? Well, we look at this. I'm making the assumption we do not allow our employees to carry over vacation. If we don't, at the end of the year, as we're in that adjustment period, at the end of the year, we look at what's the balance in this vacation pay account. And hopefully we've done a good job at estimating, and so the amount in this account is very small, immaterial. Let's say, just for the moment, let's say it's $1,000. So we had set aside $42,000 in vacation pay, but our employees only earned and took $41,000 of that. And so we've got an extra $1,000 set aside. We're not going to let our employees carry it over. And so what do? We basically reverse this entry. So we debit the vacation pay payable, the $1,000, because we need to zero that out. We're not going to let employees carry it over, so we don't have any liability to them for next year. And we credit vacation pay expense, because what that means is we had overestimated our expense, and so now we get to recoup that or get it back. Does that make sense? Now, I just said, what if it had a $1,000 credit balance? It could have a $1,000 debit balance. We underestimated, and we would do the same thing. We need to clear it out. We don't If we don't allow them to carry it over, we need to zero this account out. And we would, at the same time, be increasing our vacation pay expense because we underestimated. Rather than 42,000, it was actually 43,000. As I told you, as I was reading the exercise, they really did the hard part for us. So I'm going to spend just a moment talking about where does that $42,000 come from? It tells us the employees earn varying amounts of vacation depending on length of employment. And that's true for virtually all companies. I'm not aware of any companies that give every employee the exact same amount of vacation regardless of how long they've been with the company, unless they don't give any vacation at all. New York State has a new law related to paid time off. And so as that law came into effect for this year, it made some changes to the way that many companies were doing their budgeting for paid time off, PTO. Because now some employees that had not been eligible in the past now are eligible, and that needs to be taken into account. Those companies now, in a perfect world, or where they're required to follow GAAP, would need to be estimating that and recording it on a regular basis. What we're talking about here with vacation pay could just as well be applied to any other kind of paid time off, sick time, personal time, anything like that. The business decides how much it's going to allow its employees, subject to some kind of statutory requirements like New York State just instituted. And let's say you have a policy, something like this. For the first year, maybe you don't earn any vacation at all. From years 2 through 5, you earn 2 weeks of vacation. And once you hit 5 years, you get an extra week. So now you get 3 weeks until you hit 10 years, and then maybe you get 4 weeks or something like that. We then, just like with payroll, we have to look at each individual employee and say, how much vacation have you earned based on your length of service, maybe based on the position you hold. So if you're an hourly employee, you might earn vacation based on the number of hours you work. For a salaried employee, it might be based on the number of weeks, years, months that you've worked for the company. Then you have to do that calculation. Okay, so Susie earns 2 weeks of vacation this year and her salary is this amount, so what's 2 weeks of that? Or Susie's worked here for 10 years, and so she's getting 3 weeks of vacation, but she gets paid by the hour, and so what's her hourly rate for each of those 3 weeks? It becomes an individual calculation if we want the estimate to be somewhat accurate. It can be a complicated calculation. Now, a company that has a history can look at, well, how much vacation did we end up paying last year? What was the average over the last 3 years or something like that, and use that as the basis for their calculation. But it's, as I said, it's not an easy calculation, and to get it right, to get it as accurate as possible is a very worthwhile goal, so that at the end of the year, the amount in this vacation pay payable account is as small as possible. What's really important, what's most important, is at the end of the year, if we don't allow them to carry it over, that we zero out this account and make any adjustment necessary to make sure that for the year on our annual financial statements, that vacation pay expense is accurate for what we actually paid. Any questions about vacation pay? Again, this could be applied to any other paid time off calculation like that. It's very similar. All right, we'll keep going. So, as we talk about vacation pay, and I mentioned it, I actually think I said I was going to talk about this in the next chapter. So Forgot this exercise was here. That's totally on me. So we're going to switch gears for a moment. This is an odd item to have in this chapter, which focuses mostly on current liabilities because pension plans are long-term liabilities for the most part. There are two different types of pension plans. The traditional, the older style pension plan, which is very rarely, if ever, offered anymore, is called a defined, whoops, change my color there. A defined benefit plan. The vast majority of companies in the past offered defined benefit pension plans, and very few, if any, offer them today for new employees. There are still some around that are still in existence for employees that were hired 20, 30, 40, 50 years ago, and either might still be working under that same plan or have retired and are still drawing benefits under that plan. The newer style and much more common, and most companies, even if they used to offer defined benefit, have switched over, have transitioned for new employees to a defined contribution pension plan. And here's the difference. A defined benefit plan tells the employees, here's how much we will pay you when you retire. We will pay you X amount per month for from the time you retire until you pass away, or if it's a second to die plan, which many plans are, and I'll talk about that more in a second. If it's a second to die plan, then it's you or your spouse dies, whichever one comes second. In New York State, you cannot, if you have a pension plan, you cannot choose the first to die plan or your lifetime plan if you have a spouse. Your spouse has to sign off to allow you to take the pay it out just during my lifetime option. So if the husband and wife, the husband has a pension plan, statistically speaking, the husband is more likely to die first. And so if he has the when I die plan, then the wife would stop receiving those pension payments once the husband passes away. So in New York State, you are by law required, the wife or the spouse, I shouldn't say partner because it is legally married, the spouse has to sign off to allow that to happen. Statistically, if you think about it, if you agree to pay a pension for the combined lifetime of the two spouses, it's going to be more expensive. You're going to be paying out for a longer period of time than if you only pay until the covered employee dies. Even if the covered employee is a female, there's still a chance, certainly, that the male partner might outlive the employee. So defined benefit said, we'll pay you X amount. Then that X amount that they'll pay every month is likely based on some combination of how long you worked for the company, how much you earned. Sometimes the definition might be the average of the top 3 earning years of the last 5 years you worked for the company. That's one possible option. So think about the difficulty in calculating how much that pension is going to cost. We just went through the difficulty of calculating a vacation pay. When we said the vacation pay is going to be earned this year and taken this year, we're probably not even going to allow our employees to carry it over. Well, when are pensions earned? Same matching principle applies. You need to record the pension expense during the period that the employees are working for you. And so when you actually start paying them a pension, you have the place to write that off. So you have to be recording that liability. Hey, we've agreed to pay this pension to our employees when they retire. 50 years ago, even 30 years ago, it was much more likely that when you hired an employee, they would be with you for decades, maybe 30, 40 years until they retire. That's really not the case anymore. For new hires today, the chances of them staying even with the same company is fairly slim that they'll be with that same company even 10 years from now. Not only do workers in today's economy change companies, they change whole professions multiple times during their careers. And so think about the complication of calculating a defined benefit pension plan. You have to estimate how long the employee is going to work for you, how much they're going to make. Let's say they work for you for 30 years. You have to estimate how much they're going to be making during those 30 years to determine how much they're eligible for pension. Then, once they retire, you have to estimate how long they're going to draw that pension before the pension stops, before they or their legal spouse passes away. Then we have to calculate how much the time value of money is. And we haven't really talked about time value of money yet. We will be talking about it starting on Wednesday. But we have to estimate the present value of all of those future payments, and those future payments might start 30 or 40 years from now and go on for some estimated number of years after the individual retires. So defined benefit pension plans are really difficult to account for because there's so much estimating and so much uncertainty. A defined contribution pension plan completely turns that on its head. Rather than telling the employees, we'll pay you this amount when you retire, the employer says, we will put this amount into a pension plan for you, and we'll see how much is in there when you retire, and then we'll start paying you that based on some actuarial table of how long you'll be drawing that pension. In reality, many companies today don't offer pension plans at all in this context. Pension plan meaning the company pays you a pension, mails you a check, or does a direct deposit for you on a monthly basis after you retire. Most companies today do a defined contribution into a retirement account that the employee controls. And for most employees, that's also a preferred approach, because you own that money. It belongs to you. If you leave that company, it goes with you. It's in your name. You are the legal owner of that. But what we're talking about here is a pension plan where the company has agreed to make payments to the employees directly once the employee retires. This is not the same as a contribution to a 401k or a 403b. This is the company itself making those payments. Questions about what I've said so far? Okay. The plan requires quarterly installments to be paid to the funding agent, WIMS funds, by the 15th of the month following the end of each quarter. And so on January 15th, Uri Company, the employer here, needs to make a payment to WIMS funds for the amount of the pension that they promised to their employees for work performed in the fourth quarter of the year ending on December 31st. And so on December 31st, even though the payment isn't going to be made until January 15th, because the pension expense is related to work performed in this fourth quarter, we need to accrue that expense, record it on December 31st. Again, because of the matching principle. So estimating that dollar amount is the hard part. And again, luckily they've done that for us. Estimating that amount is way beyond the scope of this class. I've already thrown out to you some of the calculations that go into that, and they're way beyond what you would do in an entry-level accounting course. Excuse me. And then So that's our income statement account. This is an adjusting entry, so the balance sheet account is the unfunded pension liability. And because they've specifically called it an unfunded pension liability, I just want to mention that concept as well. If you work for a company that offers pension, they're required, as you can see here, to report how much they expect they will owe, and then report how much of that has been funded. That is, how much have they already set aside, literally taking money and putting it in an account that's designated for pensions. Usually that would mean setting it up with an investment firm, which is, I'm assuming, what this WIMS funds is, an investment firm that is taking that amount and investing it at some anticipated or estimated rate of return, so that the company has the money available to pay the pension when it comes due. Companies are required to report to you if you have a pension. They're required to report to you on an annual basis, do a disclosure that says, here's the total amount we believe we owe our employees in current dollars, in present value, current dollars. Here's how much we think we are going to have to pay out, and here's how much we already have set aside to meet that liability. At the time that they record this expense, they're calling it an unfunded liability because they haven't yet put aside that money. And now when we go down to the next entry, they're actually going to fund that liability. And so they're going to clear off that unfunded liability because they're actually paying it. They make the payment to the funding agent, WIMS Funds, and so they no longer have that liability because they've made the payment. And letter B, the answer to letter B, we already discussed what is a defined benefit pension plan. Oh, pays it, whoops, just chose the wrong one. Okay, so does everyone understand the difference between defined contribution, where we tell you up front, here's how much we'll put in, and then we hope it's growing, it's in the market, or it's invested, and so we hope it's growing. And when you retire, we look at how much in total has been put into that account for you, and then basically the pension will be annuitized. So they'll look at the actuarial tables, and if you don't know what that means, an actuarial table is a statistical table that, based on some criteria, how, when you were born, what gender you are, smoker versus non-smoker, those kind of characteristics, they forecast or estimate your remaining lifespan. And so they would take the amount that you have in that pension plan, and based on that, they're going to annuitize it, or tell you, here's how much you're going to get paid every year based on how much has been put in. It is really the flip side of the defined benefit, where we tell you, here's how much we'll pay you, and then you figure out how much to put in based on how much you said you would pay. It's really kind of the opposite. Any questions about that? Again, pension accounting is very complex, far beyond the what we could possibly expect of you in this class. But the reason that this is here is because it is an important concept as it relates to the matching principle, the concept of reporting all of your liabilities on the balance sheet and all of the expenses that help to generate your revenues for a particular period on the income statement. I'm going to put another term on the screen here, OPEBs. other post-employment benefits. So anything like that, anything that you have promised your employees or guaranteed to your employees needs to be recorded during the time that they're actually working and helping generate revenues for you. OPEB stands for other post-employment benefits, and that could include things like health insurance. So your employer might guarantee, for example, that if you retire at age 62, that you can stay on their health insurance until you reach Medicare age, which is 65. And so that would be a post-employment benefit. They need to report that expense, again, during the same period that you are working. And so they have to estimate how many of our employees are going to be retiring early and take advantage of that health insurance. How much do we think health insurance is going to cost then? Very complicated estimates that we're talking about here. Okay. Any questions at this point? Okay. Let's move on then. Our next exercise deals with, pages out of order. Our next exercise deals with an installment note. So we've talked about notes payable, and for the most part, our notes payable have been a single payment at the end of the maturity length. We did talk about one exercise last Wednesday where we made a regular payment plus the interest that had accrued. Remember when that exercise where they bought some piece of equipment, they made a substantial down payment, but they borrowed the rest. They issued a note payable for the rest. So I mentioned at that time that mostly when we think of installment notes, we think of an amortized loan where you pay the same amount every time and the interest and principal shifts. So upfront, early in the life of the note, when you make a payment, more of that payment goes toward interest because you owe more, and so there's more interest. And as the note gets closer to maturity, you owe less, the principal balance has come down, and so the ratio between interest and principal shifts so that you're paying relatively more principal and less interest the closer you get to paying off that note. That's the situation we're looking at in this exercise, that the company has agreed to make an equal payment every year for the life of the note. And so we're going to see that shift from more interest, less principal to more principal, less interest as we get closer. On January 1st, 2022, Hebron Company issued a $175,000 5-year 8% installment note to Vensim Bank. So we have our principal, the amount we borrowed, $175,000. We have the duration or the term of the note, 5 years. We have the interest rate, that would be an annual interest rate of 8%. The note requires payments of $43,830 at the end of each year, beginning on December 31st, 2022. So the first thing we're asked to record is the issuance of the note. They borrowed $175,000 from the bank, and they're going to report that note payable for the face value, $175,000, the amount they borrowed. So this note is different than notes we looked at in previous chapters where they were in the receivables chapter where they were issuing them for an accounts receivable. It's different than the exercise we looked at last Wednesday where they were issuing the note in payment of a fixed asset, that equipment or whatever it was, building and equipment they were buying, whatever. Can't remember exactly what it was. This is actually just borrowing money. We receive the cash and we have to pay it back with 8% interest. So we now have that cash and we have a liability to pay for it. Strictly a balance sheet transaction. Our asset cash went up, our liability notes payable. Now, part of this is a 5-year note. So part of that note would be considered a current liability because it's due this year, and most of it would be considered a long-term liability. And we would want to report it that way on our financial statements as well. Moving ahead then, we're now at the end of the year, excuse me, and we have to pay the note. Now they have told us the interest and principal, excuse me, but we could have calculated that. We could have calculated that using the same simple interest formula that we learned in the receivables chapter. The amount we owe right now is $175,000. The interest rate is 8%, and we've now had it for 1 year. So 8% of 175,000. Helps if you know how to use your calculator. Is that $14,000? I just wanted to confirm that they had done the calculation correctly, honestly, that they weren't rounding. And so, although we were given the interest, we could have calculated that ourselves. It is also not uncommon for a company to do what's called an amortization schedule at the time that they issue this note to show what the breakdown would be for each of the 5 years of the note so that they could build that into their budget, their forecast, their cash budget, and also so that they would know how much of the note should be reported as a current versus long-term liability. So again, they've given us the interest payment, but they really didn't need to tell us that. We could have calculated that ourselves. So the cash we're going to pay is what we agreed to pay. It was $43,000 something, $43,830. That payment, though, includes a payment for the interest, which they told us was $14,000, but I just showed you where that came from. And the rest of it, whatever's left, reduces the outstanding principal. So again, they told us how much the principal payment was, but they really didn't need to tell us that. We could have calculated that on our own. We know the payment is this. We calculated the interest using the simple interest formula, and the part that goes toward the principal is whatever's left. In this case, $29,830. Everybody okay with that part? Okay. Now, let me clear this. So 1 year late, oh no, sorry. That's why it wasn't working out in my head. So now we're fast forwarding. So we would have, we're just not showing it. We would have made a similar payment in December of 2023, 24, and now this is for 2025, which is the 4th year of the note. So we could go through the calculation for year 2, and I'm not going to actually do out the calculation, but I want to show it to you, just so you would see where that would come from. So in the 2nd year, the principal is no longer $175,000 because when we made that first payment, we paid off $29,830 worth of the principal. And so for the 2nd year, the interest calculation is based, it's still a simple interest calculation, I equals PRT, but the P part, the principal, has changed because we made a payment last year. And so the new principal would be that amount times 8% for 1 year. And then for year 3, we would do the same calculation, our principal again being reduced by that principal payment. And so now, to finish up this exercise, we're in year 4, we make our payment. This is an amortized loan. We're paying the same amount every year. The installment is the same every year, but we see that shift between how much interest we owe and how much principal we pay off. So by year 4, the interest is no longer $14,000, it's now down to $6,000 because we owe so much less because we've been making those payments every year. And it doesn't tell us in this case what the payment against the principal is, but as we already discussed, we can calculate that. It's whatever's left. We make our regular payment of $43,830. The first part of that goes toward the interest, and all that's left goes toward the principal. And so again, you can see from our first year payment, which was less than $30,000 going toward the principal, to our fourth year payment is close to $38,000. And so that means next year, the final year, our interest payment is even smaller. Our final payment pays off the remaining balance on that note and a much smaller portion of interest, maybe, I don't know, maybe $3,000. Any questions about an installment note? So an amortized loan where we're paying the same amount. This would be similar if you have a house payment or a car payment. It would be very similar to the way that works. You borrow a set amount up front. You make a set payment each month. The first part of the payment goes toward the interest that has accrued since the last payment using the simple interest formula. And whatever is left goes toward the principal. Everybody's good? Okay. Our last exercise, and then I need just a couple minutes to talk about one other thing very briefly, and I'll direct you to the book to read more about it. Our last exercise is about product warranty. So somewhat similar to what we've talked about with vacation pay today and pension obligations, product warranty is also an estimate. So if we offer a warranty on the product that we sell, and I think everyone knows what a warranty is, so maybe we agree to pay if something breaks. This is General Motors, so we're talking about vehicles probably. And so their warranties are going to include coverage on, basic stuff breaking on the car in the first 3 years or 36,000 miles. Whichever comes first, and maybe they have the extended powertrain warranty on, up to 5 years and 100,000 miles or whatever. I don't claim to know what General Motors warranties are, but something like that. Just like with vacation and pension, we need to record that at the time people are working. When we sell a product that has a warranty, we need to estimate the cost that warranty is going to incur and record it at the same time we record the revenues from the sale. Because guess what? The matching principle says we have to. If you record the sale, you need to match against it all of the costs that are associated with that sale. Some of those costs are going to be incurred in the current year, but if we offer a 3 or 5 year warranty, some of those costs are probably also going to be incurred in future years. So as you can imagine, just like with vacation and pension, there's a whole lot that goes into this, including looking at, well, what happened last year? How much did it cost us? How much do we think it's going to cost us per car? Doing those kind of calculations is beyond what we can do in this class, but the data are already provided for us here. We are given information from General Motors balance sheet. You'll notice these are payables. This is a current liability, and this is a non-current or long-term liability. So these are costs associated with sales that already happened, but the warranty expense won't be incurred, or sorry, the warranty work won't be done until a future year, we think. Assume that GM sales were 166,380 million, so that's $166 billion in the current year, and that the total paid on warranty claims during the year was $3,710 million. The distinction between short and long-term liabilities is important to creditors in order to accurately evaluate the near-term cash demands on the business relative to the quick current assets and other longer-term demands. So as we discussed in earlier chapters, we're looking at the liquidity of a company. And we've talked about calculations such as the current ratio and working capital, where we compare our current assets to our current liabilities. And our definition of current liabilities was they're due this year and we expect to use current assets. So we're doing that comparison to say, do we have enough current assets? Here they specifically say quick current assets. So I need to define that for you, give you a little bit more information. Quick current assets are those current assets that are already cash or close to cash. They're financial assets. So in addition to our cash account, it would include our receivables, and if we have any short-term notes, and if we have any short-term investments, those are considered quick assets. What are not considered quick assets are things like inventory, because we can't take our inventory and use the inventory to pay our debts. Something else has to happen first. That is, we'd have to sell, in this case, we'd have to sell the vehicles. So our quick current assets refer to the financial assets of the company. Okay. Questions so far? Okay. So in the year that we report the revenues, we also have to report the expense of the warranty, of the associated warranty for those vehicles, in this case, vehicles that were sold that year. Okay, so we have to figure, it doesn't tell us how much was reported as expense for this year's sales. But we are told what the sales were, and we're told what changed between last year and this year. And so we can calculate, and I think the easiest way for us to do that is I'm going to put a T account up here on the screen. So let's put a T account up here, and I'm going to look at the warranty liability, and this is an estimate. I'm going to look at this in total. I'm not going to be separating the current from the non-current. It'll just be easier for us to do it this way. So at the beginning of the year, so that would be the ending balance from the previous year, our warranty liability was $9,279. These are in millions. I'm just going to leave the millions part off. Okay. It was $92.79 at the beginning of the year. At the end of the year, we are told it was $9,701. Everybody see where those numbers are coming from? Okay. It tells us that the warranty work we did this year was $37.10, right here where I'm circling, $37.10. So when work is performed, is not when we record the expense. The expense is recorded at the time we sell the vehicle. And this tells us that the amount that was paid on warranty claims this year was $37.10. That might include some vehicles that were sold this year, or some vehicles that were sold last year. When we incur that warranty cost, when we actually do the work, the entry would be a credit to cash if we paid a dealer to do the work. Could be some part of inventory if we replaced parts, something like that. The credit part would be what we actually did. The debit part would be to reduce our future liability. Because now we've done that work, and this is very similar to when we talked about writing off uncollectible accounts. When we actually do the warranty work, we reduce our remaining liability to do additional work in the future. What we are asked to calculate for this exercise then is this number that should go right here. The exercise asks us to calculate the current period's expense based on the $166 billion in sales. How much more expense did they record? And so with what you know about balancing T accounts, we should be able to find that number. So go ahead and try to find that number. And I got $4,132. So what I did, I can put this on the screen. I started with the ending balance. I subtracted the beginning balance. Whoops. 92.79, and then added the additional amount that was added to that account, debited to that account. $4,132. And if you want to do a reasonableness check on that, it makes sense. Our warranty liability went up by about $500 during the period, $500 million during the period from 92 up to 97. And our warranty liability was $37.10, the amount that we actually performed in work. And so the new expense would need to be more than that to make the ending balance go up. And so this entry for the new expense for this year, based on this year's sales, product warranty expense, product warranty payable, is that dollar amount, whoops, that dollar amount we just calculated, $41.32. And finally, what two conditions must be met in order for a product warranty liability to be reported in the financial statements? It is probable that the liability will occur, and the amount can be reasonably estimated. If we can't reasonably estimate it, we can't put it on there. If we don't think it's going to happen, we wouldn't put it on there. And I know I only have 1 minute left, but that, let me just put our check marks in there. And that takes me to the very last thing I said I wanted to mention, and then I'll point you to the book. But any questions about this exercise? Okay, let me just go very quickly here to the other thing I wanted to mention, and that is the concept of contingent liabilities. So that very last question in exercise 10 takes us to the contingent liabilities. Contingent means it depends on something else. And so a contingent liability is something that might happen, might be a liability for us if something else happens. And probably the most frequently occurring contingent liability is someone suing us. And if we lose, we might owe, a settlement on that lawsuit. That's probably the most frequently occurring contingent liability. And just like we saw in that last exercise, whether something goes on our balance sheet or not depends on how likely is it that it occurs. If it's probable, it should be on our balance sheet if we can estimate it. If it's remote and or we can't estimate it, it doesn't go on our balance sheet, but we would disclose it in the notes to the financial statements. We would say, by the way, we're being sued. We don't think we're going to lose. Experts don't think we're going to lose. But here's our exposure. Here's the risk associated with that. So I would ask you That's all I wanted to say about that, but I would ask you to take a look at what's in your book if you haven't already read that. And if you have additional questions, as always, you can ask in class on Wednesday, but we are out of time. Anybody want to ask anything before we call it a day? All right, well, thank you all for being here, and I will see you on Wednesday.